Welcome to the Introduction to Tax Research. There are three different types of tax research. The first is planning research. Planning research focuses on open fact patterns that the client gives to you. So, client comes to you and says, we're thinking about engaging in X transaction. It has not yet happened, but we want to know what are the tax consequences of that transaction. It might be something involving the client's considering merging with another business, or what kind of entity should I be? These types of planning research issues are very important. The second type of tax research deals with compliance research. Compliance research is the most common of the types of tax research, and it deals with closed fact patterns. After the fact scenario, client comes to you after the tax year is closed and says, these are the facts from the year. What are the tax consequences? Of the three different types of tax research, this is the most important because it lays the foundation for all tax research. We're going to really focus on compliance research as most tax research courses do. The third and the most uncommon is called policy research. Policy research, the researcher is looking at different tax reform proposals, the policy underlying them that are being considered by Congress. Okay? In terms of maybe you're looking at how it could impact various elements of the legislation, potential proposals. Now, this is most uncommon, as I mentioned earlier. It's important to understand that tax is law. You might be taking a tax course in an accounting program. So you're wondering, okay, well, if tax is law, then what does accounting have to do with tax? Well, the accounting side of tax has to do with reporting. Reporting information on financial statements, income tax expense, versus what's reported on the tax return. But the actual tax complications, these three types of tax research deal with legal issues, the law, because tax is law. So you might see a fourth type of research, which deals with academic research, but that's usually focused more so on the accounting side of taxation, again, the reporting. So you might have professors that deal with academic tax research. That is a fourth type, but we're not really focused on that. That's very, very, very different from what we're talking about here. Okay, so let's go ahead. Now that we understand the three different types of tax research, let's talk about the 6 steps of tax research in general. And these 6 steps, you should know them, know the order they go in, because we do go generally in order when we're thinking about our tax research plan. So the first one is to establish the facts. Second, identify the issues. Third, locate authority. Fourth, evaluate authority. Fifth, develop conclusions and recommendations. And finally, sixth, communicate the recommendations. Now, I want to stress something to you. Just because you're going 1 through 6, it's not that rigid. Yes, we want you to start in order. Start with establishing the facts. But you might go 1, 2, and then you might have to go back to 1. You might come across establishing facts, then you identify some issues. You might say, I found some issues, but I don't know I don't know if we have enough facts to determine the issue. So you might have to go back to step 1. You might go 1, 2, 3, 4 through the authority phase, and then you might need to go back to the facts and get more facts. So it is possible. It might be circular. You might go 1, 2, 3, 4 back to 1. 1, 2, 3, 4, 5 back to 1. That's possible. That happens a lot in tax research. Just understand you might go back. It's not, again, rigid where you finish step 1, then you go to step 2, then you finish step 2, then you go to step 3. You can go back. But the idea is that this is generally viewed as the process in order. Know these steps, know the order. Okay, we're going to focus our presentation or this video on going through these steps in order to understand each of the steps. Now, at the end, I have some additional tips that apply across these various 6 steps, but you will be learning tips throughout the analysis of each of these steps. So let's go ahead and start with the first step. Step 1, establish the facts. We're not going to spend too much on this because in most tax research classes, this is not that much of your concern. Most of the concern in tax research classes focuses on locating authority and evaluating authority and the identification of issues. That's really step 2, 3, and 4 are where you focus most of your time. So usually you'll be given some facts, and the idea is you just have to parse through the facts. Most of them are going to be relevant, but some are irrelevant. We don't care about those. Now, in practice, this is actually a very important step. It lays the foundation. The facts will include who, what, when, where, and how from the client. Okay? And as a tax professional, you need to know what facts are important with respect to certain issues. Now, if you've ever been involved in a tax preparation process, you know that almost all tax preparation businesses, they have some type of what we call an organizer where it has questions for each year. Have you had any of these transactions? Do you have any children? Do you have any relatives that you're supporting? Did you purchase any stock or investments? All these different types of questions. And if something is triggered, you then know you need to ask more about the facts. That's usually how this goes about. But as a tax professional, you need to understand what exactly needs to be asked. Now, as I mentioned, as you go through the steps 1, 2, 3, 4, you might need to go back to step 1 once you know, okay, well, I figured out the authority that applies to our client, but we need more facts from the client to make a better assessment of the actual result. So that's perfectly fine. So I have an example here. It deals with property being sold and how a professional needs to know what exactly to ask about. But I don't have every single little potential example here because this is so much possibilities when it comes to establishing the facts. We're not going to spend too much time on this. You might be wondering though, what kind of things are important when it comes to facts and understand, or what kind of things trigger understanding more facts? So types of business entities involved that can affect the facts of issues, worker status, related parties that are involved, taxpayer marginal rates, other gains and losses, and AMT situation. So the idea there, and by the way, I see the related parties. It says parties. That should be related parties. My apologies. Related parties. So taxpayer marginal rates, other gains and losses, and AMT situation. And going back to like property transactions, all those different types of things. That's a huge area, but that's important. Accounting methods, whether you're cash or accrual or some other method, special tax status, taxpayer's location and location of the transaction. That's very, very important tax research, not only for federal, but also state and foreign issues. Timing of the transaction. When exactly is this going to be viewed as taking place under the tax law? These are all very important. I'm not going to spend much time on the facts. This is something that as you go in the tax research process, you'll understand more and more what you need. You can go back to the client and ask for more facts. So let's go to step 2, identifying the issues. So step 2 is, as I mentioned, step 2, 3, and 4 are where most tax research classes focus their attention. So step 2 is where you see usually tax research courses start out and they focus on this issue. The problem is that, generally speaking, for students and for those that are new to the tax profession, it tends to be the hardest part of the research process. And the reason why is because a lot of it has to do with experience, education, and training. The more you develop and hone your tax skills, the easier this identification of issues becomes. As you know more about the tax law, it becomes easier to say, yes, client, you told me that you sold your house. Okay, I know that there's a special exclusion, at the time of this video at least there is, where if you hold your property for a certain period of time, you will be able to exclude a certain amount of the gain on the sale of your personal residence, your primary personal residence. So that's the idea. You know about that rule, but if you're a new tax professional, you might not know about that rule. So then obviously this becomes a lot more difficult. So what can I at least help you out with in this process? Okay, well, one thing to do is to understand that there's different level issues when it comes to the identification process. There's different level issues. Before we go into those identification or those different levels of the issues, that helps you kind of logically think about how the tax structure works as you become more and more familiar with tax law. And I kind of give you a guide for that. I want to mention that sometimes clients are savvy. A lot of like individual tax issues, they already know about, education credits or dependency issues. And so they'll actually identify the issues for you. But that's not that common when, you're being paid a lot of money to deal with taxes. So usually as a tax professional, you'll have to identify the issues. That's your job. That's what you're being paid to do. I have some examples here. And as I mentioned, usually the individuals, they're more savvy on the individual tax, and then like entity taxation or more property transaction type stuff. You as a tax professional, you have to be able to understand all of those ins and outs. So let's go back to this area of the levels of taxation. Now, there's 5 common areas of uncertainty, and I have the different areas of uncertainty when it comes to tax issue identification. You might have, basically, in looking at these 5 issues, what I see is you can have factual issues, you can have legal issues, and you can have a mix. So factual issues, you don't exactly know what the facts are from the client because the client's not certain, and you also might need more facts going forward. to establish whatever the rules are you're looking at. Legal issues have more to do with application of propositions of a tax treatment rule or the tax treatment rules themselves, because you might see multiple ones. You're like, okay, well, what is this? Is this alimony? Is this child support? Because those are different types of tax treatment rules. Okay? As I mentioned, it really helps thinking about this, because you're like, well, how can I just jump into, understanding tax issues? And again, you have to understand that if you're taking a tax course and you're doing tax research, there is a level, at least when I teach my students, I understand that they're not going to be at the same level as someone that's been practicing tax for years when it comes to issue identification. But there are some steps you can take to better understand what's going on. So the best way to think about issue identification, think about there's multiple levels of issues in the tax law. Usually I see four levels of issue identification. The first level questions deal with the broadest aspects of income tax. We're just focusing on income tax, by the way, in this presentation. Of course, there's other types of taxation out there, but we're just going to focus our attention on income tax for the rest of this presentation. And you can use these concepts for other types of tax research, but income tax is going to be our focus. So we're at the first level. I have some checklists that can help you with looking at the first level questions, because the first level questions, they focus on the highest level. And if you go through all of those high level questions, you basically are covering all your bases when it deals with income tax, when you're dealing with income tax issues. So let's go ahead and take a look at those checklists, those questions to ask. All right. So there's generally 5 questions you should always ask when you have an income tax fact pattern. A client comes to you, you have a fact pattern on your exam or memo you need to do. You should always consider these 5 questions. What amount is included in income? What amount's deductible or credit? What is the character of the attribute? When is the amount included or deducted? And who must include, deduct, or utilize the amount? So the idea here is the first 2 questions deal with inflows and outflows, the inflow and outflow realm. Do we have an inflow of something that the client might have to categorize as income? Do we have an outflow of something that might be deduction or credit? Those are the first 2 questions. So again, that's a very, very, very broad level question. And that's fine, okay? The next is, if we do have something, then what is the character? Fourth, when is the amount included or deducted? And finally, who? Who must include, deduct, or utilize the amount? Now, not all 5 questions will be utilized in a specific fact pattern, but if you cover all 5, you're covering all possible issues out there in the universe of the income taxation. You're starting so broad and then you're narrowing down. So I'm very big on students learning, and I know students don't learn the same, all students don't learn the same. So maybe you take these 5 questions, and another way to phrase them is, let's look at whether, when, who, how much, and the character. And it takes the 5 questions and it categorizes them a different way. So whether deals with whether a particular transaction or event is sufficient to produce income or deduction. So that previous slide just showed you that each of these questions deals with both income, deductions, credits, all of those things. So whether deals basically with, is there an event that triggers income or deduction? So that's kind of like the first thing, the inflows and outflows. When should that be reported under the tax law? Who has to include or deduct the amount? So we saw that question. How much? If we do have income or deduction or credit, how much? Because there's special rules in the tax law that, okay, if you have a sale of stock, you might have to calculate that a special way. But if you just receive some wages, then you just take the whole amount. See, there's different calculations. You got to think about all these different items. Finally, the character. Characterization matters. It's important. I'll show you a slide in a moment about what the ultimate characters are. And some of you might have already taken tax courses before where you know already about characterization, but it makes a big difference. Okay? And each of these have sub-issues. So, of course, we're going to go to the second, third, fourth level issue, and I'm going to give you an example of how this works. But when you're dealing with the whether question, remember, whether there's actually an event that triggers income, deduction, credit. So for income, we can have recognition, non-recognition, or exclusion, which I'm not going to go into the specifics because this is tax research, but the idea is that those are different examples of events or different examples of issues you have to consider of a specific inflow coming in, whether it actually is affected. Deductions can be allowed, disallowed, or deferred. Okay? Same thing. You have to look at the sub-issues to see whether an outflow is going to be affected. When? So generally speaking, for income and deduction, there's the cash method, the accrual method, and there's other methods when it comes to the question of when. When do you have to include? When can you deduct or take a credit? That's part of the tax law. Okay, who? The who question is dealing with what we call the assignment of income doctrine. That's a very important area. A lot of case law derives that area of the law. There are some code sections, and I have that listed as well. But you're saying, okay, well, who actually is taxed on the income? Or who actually gets to take the deduction? You might be wondering, I've taken tax courses before, but when was that really an issue? It was always really clear. Well, you'd be surprised. There are some interesting cases out there where maybe someone owns a bond, but then they designate that they want their child to receive the interest from the bond. So they hold the bond, but then the child receives the interest on the bond. And under the tax law, the Supreme Court line of tax law, specifically Helvering v. Horse, actually the person that owns the bond, even though they're not actually receiving the interest, they actually have to pay the tax on the interest on the bond. How interesting is that? So you're going to be learning all about that in a tax research course, because that's an application, an issue you need to really consider is who has to pay income deduction. Consider that issue in an income tax fact pattern. How much? As I mentioned earlier, when you're dealing with calculating, if you have an event, a weather triggering event, you have to determine how much gain, how much loss in the actual amount, or is it the whole thing, the whole inflow? That is going to be looking at property transactions, calculation, special rules. Might have an annuity where we calculate annuities, the amount in a certain year, a special way. Finally, character. Character is huge. It's very important. There's ultimately two types of characterization in the tax law, ordinary and capital. Now, capital is broken up between long-term and short-term, but the idea is that ordinary versus capital makes a big difference. The main difference you might know about is that long-term capital gains historically have been favorable versus ordinary income. So being able to characterize something as long-term capital can save you lots when it comes to taxes versus ordinary income. So that is a huge issue. I don't want to go any further on those specific items. I'm just giving you a taste of the flavor, okay? So again, the five top-level questions, those are viewed as the first-level questions. So let's go back and see some examples of a specific situation where we have a first level, second level, third level, and fourth level situation. All right. So in the first level question, again, we're looking at the very, very, very high level. So we might ask, we have an example here, do the facts indicate that the client has received an inflow of either property or services? So we're looking at the inflow, whether there's actually some type of inflow coming in. That's that first question, right? That's what we're focusing on. Okay, so we asked that question. The second level question then focuses on specific tax treatment rules. So we're going a little bit further down with respect to issue identification. So maybe there's some type of relationship with ex-spouses or ex-partners where there's payments between them. So given the taxpayer has an inflow, maybe our taxpayer at question is receiving some money from an ex-spouse or ex-partner. Given the taxpayer has an inflow of either property or services, is this considered alimony as defined in Section 71 of the Internal Revenue Code, included in gross income, versus child support not included in gross income? Or is this some kind of other inflow that has some special income or exclusion? Maybe it's a gift for all we know. Okay, if it's ex-partners or ex-spouses, probably not a gift, right? They're probably not on amicable terms, but you never know. Could be a gift, and then it's treated as an exclusion from income. Versus alimony, depending on the year of the agreement, could be included in income by the person receiving. So we have to continue down. Third level questions, they focus on the propositions to be proven. So every every code section has a tax treatment rule, whether it's including gross income, excluding gross income, it's to allow a deduction, disallow, take a credit, to utilize a credit, to calculate something, determine a basis, whatever it is, there's a tax treatment rule. Now, when you're dealing with almost all tax treatment rules, there's propositions that have to be proven to meet the rule. So the idea is that alimony is included in gross income if it meets blank or blank, multiple blanks. So again, we're focusing on whether this could be alimony or child support. Okay? Or I should say whether it's alimony or child support. We don't know. Okay? Or we don't know what those exactly are. So at the third level, we then are now breaking out the question even further, and we're saying, given various facts related to payments between the ex-spouses or ex-partners, is the inflow received by the taxpayer in cash, which is a proposition needed to be alimony, as a result of a divorce or separation instrument. They're not members of the same household. It does not end on death or remarriage, and it does end, I should say, on death or remarriage. It does not say it's not alimony, and also we have to focus on when the actual agreement took place if there was a divorce or separation instrument. Okay, and again, there's no modifications or whatnot. So these are all propositions. So then the fourth level is really the final, and you can go even further, but I generally see 4 levels depending on who you ask. The fourth level focuses on those different propositions. For example, it needs to be alimony. It has to be part of a divorce or separation instrument or decree. So then the question arises, given the various facts related to payments between ex-spouses, is there any reason why this is not part of a divorce or separation instrument because it does not qualify as blank, and you're defining what the divorce or separation instrument is. So you're trying to argue, does it meet the propositions, each specific one? So you're getting down to a very low level because we started at a high level. Do we have gross income? And now we're all the way down at, does it meet a specific proposition, right? We've gone from the highest level, is it an inflow that meets gross income? Specifically, is it alimony? It's the second level. The third issue is, or is it alimony or something else? The third issue is, does it meet 5 propositions? And then fourth is, what are those propositions specifically? So see how we do this? We basically are going in a logical order. So you're asking me, well, why is that so important? It's important because it helps you understand that when you identify issues, you might need to go back to that first step to get more facts, because we might not have enough facts to determine whether there's a divorce or separation instrument. So it's like, well, I got to go back to the client and ask, hey, do you meet, and ask more about the divorce or separation potentially, right? If there even is one. Is it a formal process? Was there a formal process? Was this more informal? Those kinds of things. Because the law specifies what divorce or separation instrument is, and you have to meet that to be alimony. So that's the idea. The second reason why we do this is because in your memos, when you're writing memos, you want it to be logically structured like this. You want to have a logical progression going down and showing your reader, your audience, hey, I start at the top and I go all the way down. All right, so now that we've done issue identification, let's talk about locating authority. So locating authority, this is where tax research courses, they focus time. Now, and students love this. It's like a scavenger hunt in a way. But it's really important that you understand that there's various tax research databases out there. There's really 5 major types of tax research databases. And they might have had different names. This is at the time of this video. They usually change different names, but they keep the same semi part of the title or whatnot. So the first, Checkpoint. Second, CCH. Third, B&A. Fourth, Westlaw. And fifth, LexisNexis. Now, different people prefer different ones, but I would say that Checkpoint and CCH are probably the most common. Okay. One thing to note is that these are all paid services. So if you are a solo practitioner, you have to pay sometimes a pretty penny, especially if you're dealing with things like Westlaw. You have to pay money to use these services because they're providing you with up-to-date tax law, and they're also making sure the tax law is still valid. There's nothing that's overruled it. Now, you can use free resources online, but just like I said, these sources, they cost money. That's the drawback, but they are going to provide you with the most current and updated, so you know you're using the most applicable law. They also provide lots of secondary sources. We're going to talk about those in a moment that help tremendously with the tax research process. Okay? So going with that, tax authority can be classified as 2 types, primary or secondary. Okay? Primary or secondary authority. So primary authority is what we really want. We want to reference and whenever we have a tax research issue, we want to find primary authority. And specifically, we want to find primary authority that's binding. So primary authority can be either binding or can be non-binding, also known as persuasive. Secondary authority is always non-binding. It's going to be potentially persuasive. Okay. And when I say persuasive, there's obviously different levels of persuasiveness depending on, whether you're in a court or whatnot. Okay. Now that's primary or secondary authority. Before I go any further, I want to show you the 5 different major tax research databases. I just want to show you what each of them look like at the time of this video because they change formats so frequently, what they all look like going in. I'm just going to go in order: Checkpoint, CCH, B&A, Westlaw, Lexis, and then we'll come back to primary, secondary authority. I'll talk more about them. Okay, but keep those in mind, the primary and secondary authorities. All right, so what you see here is Checkpoint. Checkpoint. Now, this is probably the most used of all the 5. And what you see, this is the main search page, which is where we do most of our searching. And there's videos out there you can find on YouTube. Actually, if you look for my How to Write a Memo video, I talk about Checkpoint. But this is just the home page. I just want to show you, and so you can get a kind of an idea. But there are videos out there about using Checkpoint, using all these different 5. You notice there's primary source materials. These are the primary source materials I just mentioned. So they actually group that for you versus editorial materials. This is where you're going to find your secondary sources. So let's go on to the next one. All right, so this is CCH. So this is what CCH looks like. Again, it's structured very similar. We've got different aspects here where we can go through our primary sources and whatnot, all content. We can break this up, federal tax. We can break it up in editorial primary sources, just like you see here. So Checkpoint, CCH, they tend to be very similar in structure. They obviously have different editorial materials that they provide themselves. But the idea here is that they're very similar in structure, what they do. The editorials, again, that differs. But it really comes down to personal preference. Some people prefer CCH, some people prefer Checkpoint. So if you work at a firm where you use one or the other, you're probably going to become very familiar with one versus the other. Okay, so this is Bloomberg, previously B&A. This one is not as common, but there is one thing I want to show you that Bloomberg has that's very important. So if we go down here and we go to the practice centers and tools, and because Bloomberg law is obviously, it has multiple aspects of law, but one thing is that people in tax practice talk about B&A portfolios. These are treatises, not treaties, treatises that are used by tax practitioners in order to really locate and find like an all-exhaustive discussion of a topic. And also for those people starting off in a topic, it's very helpful. If you know, hey, this is a medical expense issue, you can find a portfolio that deals with that. So the B&A portfolios, you can actually search through them or find the portfolios, and this can be very helpful. So if you ever see someone talk about B&A portfolios, they have them here. It's a table of contents view, but you can actually search through them. So let's go to the next one. So here we have Westlaw. Of all the 5, this one is probably going to have, I would say this one has the most. It has the most stuff. In the legal profession, this is what's most used, Westlaw. People are really, there's a Westlaw versus Lexis battle, and people are very adamant about Westlaw, using Westlaw. Westlaw has the ability to have the most stuff. Now, with all these different services, it's very custom. You can have more and more, subscriptions to things, and it costs more and more money. So, you could have a very basic Checkpoint or very basic Westlaw, but those tend to be more expensive than the other counterparts that go with them, like CCH and Lexis, and you get more stuff. But these, Westlaw especially, when you're dealing with lawyers, this tends to be what most lawyers use. Okay, if you have accountants and people at the accounting firms, they tend to use Checkpoint CCH. But if you're dealing with a law firm, this is what they're probably going to be using, Westlaw. The other common legal tool or database is Lexis. Now I have LexisNexis. I have the Nexis Uni, which is a more condensed version for universities. I don't have access to LexisNexis at my university, unfortunately. I'm in Westlaw again. I have the full access. But Nexis Uni, this is good. LexisNexis, one thing that LexisNexis has that the other ones don't have is what's called a shepherdizr. So citators, I'm going to mention that in a moment. If you pull up a case, I'm just going to pull up a famous tax case called Glenshaw Glass. If we pull up that case, search for it, and the first case that comes up, that's the Supreme Court Glenshaw Glass decision. What you're going to notice is that on the right side, we have this shepherdizing. You're able to shepherdize. And shepherdizing deals with citator, and it's viewed as shepherdizing tends to be probably the most popular of all the different citator services, shepherdizing. So that's probably one of the big benefits of Lexis. I just want to bring that to your attention. But these are really the 5 different types of tax databases. All right, now that we've gone through these 5 databases, and I mentioned primary versus secondary authority. I haven't talked about secondary yet, but I mentioned primary authority. I wanted to say primary authority first because as you saw in Checkpoint and CCH, you could see that it actually breaks it into primary and secondary for you. But again, primary authority is what you're looking for when you do tax research, because Primary authority, you're gonna read below, has to deal with what we call substantial authority for avoiding tax penalties for both the client and the preparer, which as a tax professional, you're viewed as a preparer in many cases, and you got to be very careful. Now, secondary authority, you cannot generally cite to. Almost never can you cite to secondary authority. Very, 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 very rare. Just don't do it. If you're in a tax research class, I wouldn't even do it. Okay, I would only cite the primary authority. As I mentioned, primary authority can be both binding or non-binding, persuasive. Secondary authority, never binding. So secondary authority is more like editorial services, like within these databases, there's different editorial explanations and annotations. For example, Checkpoint has what's called the Federal Tax Coordinator. Very, very, very good service. But things like treatises, like the B&A portfolios or WGNL, Warren, Gorham, and Lamont, very common in the tax industry for treatises. Treatises give you an exhaustive description of an area of the law if you're looking to get really, really, really deep in an area. So secondary sources can be very useful in helping you navigate through the actual tax law, through the issues. But secondary sources, you generally do not, again, almost never do you want to cite to them. And I just recommend, if you're taking my tax research course, do not reference a secondary authority. Okay, so as I mentioned, the reason why primary authorities are so important, among multiple reasons, is the main reason, and I just go right to this when I tell students, there are tons of tax penalties in the tax law. Tons of tax penalties. One of the tax penalties that's most common is known as the substantial understatement penalty, which can be up to 20% of the understatement on both the preparer and the client, the taxpayer. So one way to mitigate these penalties is to have what's called substantial authority. Now, substantial authority has been defined to be different types of primary authorities, which I'm going to list below in a chart, but I have a list here, you can read them, and there's actually an IRS notice in the regulations I have listed there, actually lists to define what substantial authority is. And there's different legislative, administrative, and judicial, the three branches of government. There's different types, okay? So now, rather than list all these out, I actually have a chart below that I'm going to walk you through these different types of primary authorities. Now, before we look at these different types, and I give you a little description and some notes about them, and then at the end of this, I'm going to show you some examples of some of the more important ones. Let's look at what the charts, what their titles are. So the first column is the actual primary authority, okay? And I have a numbering system which actually applies to the third column, but I want to note that 1 through 5 are binding, 6 through 10 are not. So if you have a number 1 through 5 in there, it's binding. If it's a 6 through 10, it's not binding. Because remember, primary authority can be either binding or non-binding. The type, the second column, that deals with legislative, so you're dealing with Congress. Administrative, so you're dealing with the IRS or Treasury, or J for judicial. So L for legislative, A for administrative, J for judicial. So legislative is Congress, A for administrative, it's the IRS or Treasury, and J for judicial, so we're dealing with cases. So level 1 through 10. So a 1 is the highest level. A 10 is the lowest level when it comes to primary authority. Again, 1 through 5 are binding, 6 through 10 are non-binding, and again, they couldn't be persuasive depending on the level of persuasiveness viewed by the court or the IRS. And then I have a description column at the end that kind of defines it, gives you a little idea. It doesn't define it fully because I recommend for all these things, stopping at some point and going and just Googling each of these things, the U.S. Code, an example of a revenue ruling, a revenue procedure, and seeing what these look like to get an idea. Okay, let's go ahead and start. So the first one is the U.S. Constitution, which of course is L for legislative, and it's the highest law of the land, so it's a number 1. Now, it's extremely, extremely rare to reference the U.S. Constitution in tax research. You almost never are going to do this in a tax research course. The times you do this have to do with whether there's some constitutional right for someone to tax or a authority to tax, which almost never is an issue. Okay, the next row down, we have U.S. Code section. This is very, very, very important. Please take a look at this. And I have an example later on that shows you an example of what a code section looks like. So L for legislative, number 2, so it's very, very high. The code is the final tax authority for most matters. The answer to any tax question must first be tied to a provision of the Internal Revenue Code. When you're writing a tax memo, the first thing you want to do is reference an Internal Revenue Code section or multiple ones. That's my rule of thumb, and you should always do that. Always start your analysis section of your memo with citing to a code section. Okay. Also, interpretations such as regulations in court cases may help understand how a code provision is applied, but the ultimate authority is still the code. So the U.S. tax code is the ultimate authority. I mean, the Constitution is, of course, higher because it's the highest law of the land, but it's very, very rare to have the Constitution. So the code is like the Bible when it comes to tax. Note that sometimes not all provisions of a tax act, given each year, are eventually codified or codified. For that reason, it's frequently necessary to examine the full tax act because there might not be something in the tax act that's actually in the code. So that's very important. The tax act, the legislative act itself, is still the same level as the code. It's just not in the actual code. And the code, by the way, is the U.S. Code Title 26. Okay, next, U.S. treaty. So a treaty of another country. And notice I said treaty, not a treatise. Treaty is a primary source material. Treatise is a secondary source. Treatise is used to give you an exhaustive description of an area of tax law. A treaty is between the U.S. and another country, and it's an agreement made between two countries to resolve tax issues such as double taxation. This is a legislative element because it's by Congress, and then number 2 because it's very high. Now note that both the code and a treaty have a number 2. So the question arises, what happens if you have a treaty and a code and both have conflicting elements? Well, the courts generally tend to give equal weight to both the code and treaties. That's why I've given it number 2. And then when the two are in conflict, courts generally, they go with whatever has been enacted later or adopted later. Now, I want to stop for a second. I'm going to reference this later at the end of this chart table. And I want to mention that these numbers I give for the level, this isn't a pure environment, which in tax research almost never happens. So this is just kind of like my rules of thumbs. Don't use these in actual, I'm going to condition this in tax practice. There can be other issues that make this not as rigid or not the case. There might be something that's over another thing. And you're going to see in some of these actually say, oh, both are applicable or it's applicable or, in the same jurisdiction, or something's, one's more relevant than the other, right? That's obviously a matter of art or looking at each case by case. So you can't just apply this across the board to everything is my point. Okay. All right. The next thing, committee reports. So committee reports are non-binding. They're legislative and they're an 8 out of 10. So remember, 1 through 5 binding, 6 through 10 non-binding. So it could be viewed as persuasive. The committee reports of various congressional tax committees, which the main or the tax committees in the Congress are the House Ways and Means, which is in the House, the Senate Finance, the Senate, and the Conference Committee, which is a joint between the two in putting together, are written contemporaneously with the legislation and are useful indicators of congressional intent. Now, committee reports may not be used to overturn the plain meaning of the words in the statute itself. And as I mentioned, they are not binding. So you can use them as primary source materials, which again, substantial understatement penalty, but they can't be relied on solely. You got to find internal revenue code or cases or something else, regulations out there because that are binding. Next is what we call the Joint Committee on Taxation Blue Book. The Joint Committee on Taxation report, known as the Blue Book because of its blue cover, is often regarded as the most comprehensive and lucid explanation of the new tax law. So it goes along the same lines as the committee report. This is some type of report that's not the actual law itself, that goes behind the intent or the history of the actual provision, the sausage making process of enacting law. But again, it's not the actual law itself, not the actual language itself. So it might talk about the history and whatnot and what kind of some of the thinking was. But again, you're going to see it's a 9. It's not as high as the committee report. And you notice that it's not binding. It's not a 1 through 5. So over the years, the courts have traditionally given this less, and the reason why is because it's not contemporaneous like the committee report where it's written as the law is going on. This is actually written usually sometimes multiple years after the actual act is passed to give by the drafters to give some oversight or some intention. Now, there's been 2 recent events, though, that have given the Blue Book more authority. The first is that substantial authority notice and regulation does say that you can use the Blue Book for substantial understatement purposes. And then the U.S. Supreme Court in FPC versus Memphis Light actually did reference the Blue Book, and it said it provides a compelling contemporary indication of the legislation's effect. So that's very important, the Blue Book. Okay, and again, all these things you can look up as I'm talking about them. So if you want to stop the video and say, oh, I want to look up an example of a blue book, there's a blue book written for every tax act. Next, congressional record. So this is the lowest. It's the number 10. Again, we're still dealing with legislative. I have them grouped in order: legislative, administrative, and then judicial. So these represent discussions between members of Congress and the managers from the Joint Committee. There's colloquies and floor statements, and they may be relied on only in the event the statute or committee reports fail to yield any insight. And then there's some question as to how much weight. I just kind of give it a 10 because, again, it's not the same as a committee report or joint committee on taxation. One thing I want to stress is that it's not as common to see referenced in tax research these legislative intent documents like the committee reports, congressional record, joint committee on taxation. So I'm not going to spend as much time on these things. Okay, so let's move over to administrative. So we have Treasury regulation that will be given deference. So this is administrative and it's a level 3. It's not the same as the code, but it's a regulation. So regulations represent the Treasury and IRS's official interpretation of the code. The following are 3 kinds of regulations. So we have legislative, interpretive, and procedural regulations. Now, regulations are similarly written and structured like the code itself. So if you know how the code is written, usually you're going to see the regulation kind of follows suit. Now, legislative regulations, generally, they're created as having the same force and effect of the actual tax code because a legislative regulation, you're going to see in the tax law itself, Congress basically gives the IRS or Treasury the ability to write regulations on its behalf on an issue. Not the whole code section, but an issue. Interpretive and procedural regulations, though, generally are given the full force and effect of law, so they're given a 3. They're not the same as the code because, again, Constitution says Congress is the one that has the power to write the tax law, not the IRS or Treasury, right? That's the executive branch, right, through the president appointing the Secretary of Treasury and then Secretary of Treasury and the IRS commissioner. So they call that administrative. But interpretive and procedural, they can be given the full force and effect of law, number 3, if they're given what's called deference. So deference basically means, in the courts judge deference, and this uses administrative law, basically courts are saying, okay, in this specific situation, yes, the administrative role or the executive role of the Treasury or IRS, you are doing your improper authority to do what you're doing. And there's a whole line of administrative law, many, even there's a whole semester in law school on administrative law that focuses on this issue, whether the administrative, the Environmental Protection Agency, the various agencies out there, not just the IRS, but you're talking about all the different agencies made up in the executive branch, whether they have the ability to actually write law, and when Congress generally is given the right to do a lot of these things, or has the right through the Constitution, has the task through the Constitution. Now, what happens if a Treasury regulation is not given deference? So the courts say it's not. Well, it's still considered primary authority, but it's not binding. So I gave it a 6 because it's still a Treasury regulation. What you're going to see, Treasury regulations generally go through a more formal process than most other administrative sources of law. Now, one thing I want to mention, I don't have noted here, but there's actually final regulations. There are proposed regulations and temporary. Generally speaking, final, temporary, and proposed regulations, all 3 of them can be treated the same under these cases. Whether it's given deference or not, doesn't matter what's final, temporary, or proposed. It can still have that same 3 or 6. Now, one thing I want to note is that there are some limitations on temporary and proposed regulations in the sense that they might not have the full force after a certain period of time because maybe it's lapsed. All right. So in the Treasury regulations that aren't given deference, and I talked about the different types of regulations above, I noted that courts have not been hesitant to overturn regulations if they don't think that the IRS or Treasury has the right to be writing the law on this issue. So that's what we mean by the deference. And in some cases, the IRS may continue to follow a regulation that the court might view as, hey, there's no deference here. And that's also why I gave it a 6. And that's because maybe in like one jurisdiction, one circuit, U.S. Circuit Court of Appeals, they don't view the regulation as having any importance. But then other In other circuits, they do. So IRS, which has a national view, they don't want to, we're going to treat this one way and the other way. They take a national approach. They basically say, well, unless the Supreme Court says otherwise, we're going to still stick with our guns, even though Circuit 1 has held different than Circuit 2. Okay. So revenue rulings, I'm going to go kind of quick through a lot of these administrative provisions just because they take, we could spend so much time talking about these things. And again, I recommend taking a look at all of these things, stopping the video and taking a look. And I have some examples after this table I want to show you, but I'm not going to go in exhaustive detail on every single one. Next, revenue ruling. So we're still dealing with administrative, so it's the IRS. It's a 5, so it's binding. Revenue rulings are official IRS interpretations of tax consequences, and what they generally are what you see in a revenue ruling is you have a fact pattern, and then you have the IRS's interpretation of this. Now, some courts, they view revenue rulings as having no weight, but others, they have lots of weight. And the IRS, they view it, of course, because it's their document, as having lots of weight. And actually, if a taxpayer takes the view of a revenue ruling, that approach, or that they take that outcome, that interpretation, but then IRS argues against it, and then the IRS loses in court, they actually have to pay the other side, the taxpayer's attorney's fees. That's really important to understand. Revenue procedures in most courts are viewed higher than revenue rulings, but it depends. It depends on the situation. Revenue procedures are more like procedural guidelines. They come, like a lot of revenue procedures come out every year, the same topics. Like, two popular uses of revenue procedures deal with how exactly to obtain a letter ruling and specific areas the IRS is going to not decline a revenue ruling on, or a private letter ruling. I should say. I'm going to talk about private letter rulings in a moment. There's not many of these each year, just so you know. So keep that in mind, but they deal mostly with procedural issues, and a lot of them actually end up becoming, or I should say a lot of them, some of them end up becoming regulations, because a revenue procedure is not as formal as a regulation, which remember had a higher level. And the regulations, by the way, are written by the U.S. Treasury or the IRS, and all these other administrative pronouncements, the revenue rulings, revenue procedures, private letter rulings, etc., going down the line of administrative, all written by the IRS. Okay, so now we're going to the administrative items that are non-binding. So you're going to see 6 through 10. First, I want to mention private letter rulings. So a private letter ruling is kind of like a revenue ruling, but it's obviously non-binding because it's a 6. It's only binding on the taxpayer requesting it. So basically, taxpayers send in a fact pattern and they say, IRS, how do you rule on this? And usually it hasn't yet occurred. It's usually a proposed transaction with respect to the event. Okay. And then the IRS then rules on it. Now, these are non-binding on other taxpayers. Okay. Technical advice memorandum, TAMs. I gave this one a 6, like private letter ruling. A TAM represents the IRS's response to a request by IRS district office or appeals officer regarding a technical question that develops during an audit. So these are kind of like internal memorandum through the Freedom of Information Act. Now they're accessible. They weren't at one time, but now they are to practitioners in the databases. So next thing we have is a field service advice. So a field service advice, or FSA, is a 6 as well, administrative, is a memo issued by IRS to IRS agents, attorneys, appeals officers, and it's kind of like a TAM in a way, a technical advice memorandum. This one, you're going through like an audit, and they're talking about the hazards of litigation, developing an issue, whether, they think they have a good position or not, the IRS. Determination letters are at the bottom of the totem pole. They're a 10, and this is a DL, a determination letter, is actually issued by the office of a local IRS district director. So it's not national. So all the previous ones I mentioned, private letter rulings, technical advice memorandum, field service, those are all from the national office. This is from a district office, a district. Okay. So it's not as high. And again, you're seeing there's kind of, this is kind of like a private letter ruling where someone is requesting, but it's focused on the IRS, an internal element itself, whether, granting a tax-exempt status is very common on this one. They get something from a taxpayer that's asking, we want tax-exempt status. And they're saying, okay, we have this issue. What should we do? So that's kind of what's going on there. So the other ones you're going to see are 8 through 10 for the administrative elements. I'm just going to go through them even quicker. Announcements and notices. So IRS publishes announcements and notices, what they believe is necessary to provide interpretive guidance to the public. So as you go more and more up the totem pole, there's more and more of a formal process. From the most formal process being a regulation, then you've got revenue rulings and revenue procedures, which all these regulations take like comments and they take into consideration the public and all these different things. And they go through the whole administrative guidelines. That's what that deference was all about. But then revenue rulings, you have a more formal process than private letter rulings and so on. So the lower you're going, it's less formal, just so you know. Okay. So you have announcements and notices. This one isn't more informal. This is usually comes out real quick if there's like an issue that's coming up, just so you know. Okay. So we've got General Counsel Memorandum. General Counsel Memorandum is it's issued by the Office of the IRS Chief Counsel in response to an internal IRS's request on legal analysis. So it's kind of along the same lines as the field service advice, but this is more along the lines of, okay, we're looking for specific issues out there dealing with a certain area of the law, versus the other ones deal more of like audits, like potential, okay, we're thinking about auditing this client, where the hazardous litigation, if they want to go to court, those types of things. So a technical memorandum is more or less a letter of transmittal from the IRS Commissioner to the Assistant Secretary of Treasury for tax policy that accompanies Treasury decisions, final regulations. So this is much more of the informal process when it comes to the more formal items itself. So it's like a letter that goes along with it, and these actually are not as common anymore because now they just become the preamble to the regulations themselves. So if you look at old regulations versus newer regulations, for example, at the time of this video, some of the newer regulations that are coming out deal with like Section 199A, qualified business income deduction. If you look at the preamble, which is real long, that's basically what the technical memorandum used to be. So the preamble to the regulations, that actually goes through the whole formal process, but no longer it does that. So next thing is action on decision. As I mentioned earlier, sometimes courts, they rule a certain way, but the IRS doesn't agree with it. We call this acquiescence or non-acquiescence. So if the IRS acquiesces, they agree with the court and how the court, their decision, and non-acquiescence means the IRS is still gonna pursue the way they're pursuing it because maybe it has multiple distinctions in different circuits. Because the idea is that, again, the IRS is a national agency, a national department, and what you're dealing with is you don't want to have, oh yeah, we're going to argue or treat the tax treatment this way in one jurisdiction, but a different way. That you can't do that because then you start creating issues of fairness with different taxpayers. So action on decision is basically a statement that comes out from the IRS that says, oh, in this case, we acquiesce with the decision. We agree with the court and we will uphold the court's rationale when the IRS loses. Non-acquiescence is when the court basically says, we're going to continue to go against. So next, we have the Internal Revenue Manual. Again, you're seeing lots of internal stuff. I mean, this one, as the name suggests, Internal Revenue Manual, that's internally what the IRS is writing each year or annually, and different items about different situations. Information letters, you can read about that, but you're getting a lot of the same concepts you're seeing. Okay, technical information, TIRs are issued by the IRS to inform public quickly regarding important technical developments. So kind of like notices and announcements like we saw above. That's kind of what a technical information release is. Just maybe a little bit more technical than the information release before. All right, so now we get down to our judicial elements. So we've got three levels when it comes to courts. We've got the U.S. Supreme Court, we've got the U.S. Circuit Court of Appeals, and then we've got the trial court level. Now for all of these, I'm basically saying that they all are applicable. Of course, the U.S. Supreme Court is applicable to any court in the U.S. So that's a 3, okay? That's a 3. So decision for SCOTUS, or Supreme Court of the United States, that's what SCOTUS means, is the highest level decision in the U.S. All taxpayers must follow these cases. SCOTUS rarely issues decisions on tax matters, okay? So if you have a U.S. Supreme Court case that applies to you, you need to follow it. Now, generally speaking, the U.S. Supreme Court tax cases are going to be broad application. You're not going to be going there for facts. And also, just so you know, it's very rare for Supreme Court of the United States to issue tax opinions. Now, between 1913 and 1954, there were many tax Supreme Court cases, but after, I would say, 1986, there has not been that many. Okay, there have not been many. The Supreme Court does not like to rule on tax issues, generally speaking. And a lot of the issues have been hashed out already, and usually the issues that come up now are more about, again, the taxation, the constitutionality of taxation. So the next, we have the U.S. Circuit Court of Appeals. So all the trial courts we're going to talk about, they all appeal up to the U.S. Circuit Court of Appeals. This is a level 4 if it applies in your jurisdiction. So we're talking about the U.S. Supreme Court cases being similar to a regulation that has deference. A U.S. Circuit Court of Appeal might be less than the regulation if again, the regulation has deference. But still very important. Again, 1 through 5 being binding. So if a federal tax case is appealed from a trial court level, it will be decided at the U.S. Circuit Court of Appeals level. And by the way, U.S. Supreme Court, if you appeal your U.S. Circuit Court of Appeals decision to the U.S. Supreme Court, it's not for sure going to be granted to be heard. But if you appeal your trial court level, U.S. trial court tax level, up to the Circuit Court of Appeals, they can affirm the decision to take it and hear it, the whole thing. But the idea is that you get at least one appeals. You might remember that or have heard about that from law courses, but you get one appeal. So you get your appeal. You might not be heard the full thing in a panel, or it probably will be heard in a panel, but usually they affirm the lower court's decision, almost always, but not always, okay? So U.S. Circuit Court of Appeals, there's many different jurisdictions, and the idea is that your trial court, the general rule is that you're appealing from the geographic location that you're located in to the U.S. Circuit Court of Appeals in that residence. The one exception to that is one of the trial courts, the U.S. Court of Federal Claims, actually appeals always to the D.C. Circuit Court. Always goes to the D.C. The U.S. Court of Appeals of the D.C. Circuit, I should say. It's the D.C. Circuit. Okay. So let's talk about the trial court levels. There's 3 different trial court levels, and I'm not going to go into the specifics of why you might pick one jurisdiction over the other, but let's just say, again, assuming that all 3 of, looking at each of these, if it was applicable, I gave them all 5, so the lowest level of the 1 through 5, if it's applicable jurisdiction, again. We've got the U.S. Court of Federal Claims, we've got the U.S. District Court, and we've got the U.S. Tax Court, okay? So the U.S. Court of Federal Claims deals with only matters of the U.S. government, taxes, deals with federal issues like contracts and whatnot, the federal government, and it's always heard in D.C. It's based solely in D.C. Now, this is one of the 3 trial courts you can pick, and of the 3 trial courts, 2 of them, you have to pay your deficiency. The IRS has a deficiency on you. They say, okay, well, you owe this amount of money. You pay it, and then you have to sue for a refund. This is one of the refund courts, okay? So if you appeal the U.S. Court of Federal Claims, then it goes up to the D.C. Circuit for the Circuit Court of Appeals. The other 2 ones are the U.S. District Court. Let's talk about that. That's one of the other refund districts. So again, you have to sue for a refund. You pay the tax you owe, and then you sue for a refund. So IRS assesses a tax. You have to pay a refund. Now, one thing about the U.S. District Court is it's the only one of the 3 courts that can have a jury potentially. Not always going to have a jury in a tax case, but you potentially can have a jury, which could make an impact on why you go to the U.S. District Court over the other 3. There's many, many, many districts in the U.S. Some states have many districts. So you got to look at what district you're in the line of law in there. Basically, U.S. district courts hear varied cases. They hear criminal cases. They hear all different types of civil cases. They hear so many different types of federal cases out there. Finally, the U.S. Tax Court. The U.S. Tax Court is the only one of the 3 courts that you don't have to pay to play. You don't have to pay the assessment and then sue for a refund. If the IRS comes at you and says you owe money, you can just sue the IRS and say, okay, well, I'm not paying it. Then you go to tax court. Okay, you then go to tax court. Okay, technically the government is suing you because you're not paying what you owe, what they view you owe. So this court actually has judges that are devoted 100% to tax cases. There's a small U.S. tax court level, small courts, and there's also the regular tax courts. Now, there's 3 different types of decisions. There's the regular decision, the tax court memo, and the tax court summary opinion. The tax court summary opinion comes from those small court divisions, and you can't, those are never binding. And you actually can never rely on them. So they're not even a 1 through 10. But the regular decision, the TC memo, those are going to be 1 through 5. Now, regular decisions can be decided by one judge or what's called en banc. En banc means that multiple judges can hear it. And even in some cases, all of the judges will consider the issue and they'll rule on the decision. They won't all be in the courtroom, but the facts will be taken and stuff, and they'll rule on the decision. So one thing to note is that for the U.S. District Court, it's whatever geographic location you're in, that's what Circuit Court of Appeals you have to follow. For the U.S. Court of Federal Claims, again, you're following the U.S. Circuit Court of Appeals for the D.C. Circuit when you deal with the level of law for what's binding, if you have different tax issues that have different outcomes in the different circuits. The U.S. Tax Court, even though it's a national riding circuit where it goes all around the country, the U.S. Tax Court can rule differently on the same set of facts in one circuit versus another. This is known as the Golson Rule. The Golson Rule, which came from a line of case or actual tax case, basically says that the tax court must consider the district that the taxpayer resides in, the circuit the taxpayer resides in when making the determination. So if there's an issue where there's different circuits, for example, I'm going to mention one later about reasonable compensation. Well, different circuits, they rule differently on how to determine reasonable compensation for purposes of determining the tax law, what's deductible or not. And if you're in the Fifth Circuit versus the Seventh Circuit, you're going to have different tests. So you could actually have a fact pattern where a judge hears, the same judge hears this same set of facts in the Fifth Circuit, and then the Seventh Circuit hears it, and it might have different outcomes because based on the different tests of the different circuits, it might end up being treated differently. Very interesting, but you have to know about that. That's the Golson Rule, okay? All right. So before we go into evaluation of authority, which we've kind of already done, I actually want to take a second to show you some examples of some major types of the primary authorities I mentioned. So here are some examples of primary authority. The first one, of course, because again, I mentioned how important it is, it's always your starting point, is here's an example of an Internal Revenue Code section. And of course, you can't rely on this always in the future in this video. This is at the time of this video. So we have section 213 dealing with medical dental expenses. What you see is that it starts off with a general rule, allowance of deduction. There shall be allowance of deduction, the expenses paid during the taxable year. So the tax treatment rule, general rule is you're allowed to take a deduction if it meets certain criteria. And then the propositions are going to be met or specified in that specific subsection. Subsection A there they talk about for medical care of the taxpayer, his or her spouse or dependent, determined without regards, blah, 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 to the extent that such expenses exceed 10% of the adjusted gross income. Again, if you're looking at this later on, you need to note that might have changed in the future, so don't rely on this section 213 when you're watching the video. Okay. And then, it goes through various subsections and whatnot. I have some definitions. What exactly medical care? So one of those propositions, it has to be medical care. And I actually define that because I actually have a video, and I recommend you watch it. It's called How to Write a Tax Memo. It actually goes through a fact pattern dealing with medical expenses. Really interesting fact pattern about someone with having to install and build a pool based on a medical condition and use the pool, and whether the purchase and building of the pool can qualify as a medical expense deduction. So I go through that. So I use section 213 in this discussion. Okay. So let's go to the next item, we're going to look at the regulations. I have a regulation here. This is regulation 213-1, 1.213-1. And this regulation, by the way, does have deference, just so you know. So it's going to be a higher level. It's going to be a binding authority. And regulations are structured very similar. They follow the code, talk about allowance of deduction. Section 213 permits a deduction of payments for certain medical expenses, except as provided, blah, blah, blah. So you notice that the language is very similar to how the code section starts out. And that's exactly correct. And it follows that same format of the code section we just looked at for section 213, which remember, the code section is always where we start. So basically the code section says you can take a deduction for certain medical expenses. Then we go to the regulation to help us give more interpretation. So in our example in the How to Write a Memo video, we needed it because one of the issues in the How to Write a Memo video is what happens if you have an expense that lasts longer than a year. So in the regulations, we find some definitions. It defines deductions for expenditures medical care allowable under Section 213 will be confined strictly to expenses incurred primarily for the prevention or alleviation of physical or mental defect or illness. So that goes to the definition of medical care. And then here is what I was talking about with the issue where, okay, a pool lasts longer than a year. Well, how does that work? So capital expenditures are generally not deductible for federal income tax purposes. See Section 263. So it actually references other code some code sections. However, an expenditure which otherwise qualifies as a medical expense under Section 213 shall not be disqualified merely because it's a capital expenditure. So just because it lasts longer than a year, we're generally speaking under the tax law, we would have to depreciate over time. If it's an allowable deduction, we depreciate it because it lasts longer than a year. Just because it lasts longer than a year does not mean that, hey, we have to capitalize and depreciate. We can probably take all the costs this year if we meet certain other criteria, which is very interesting. And that was an element in the How to Write a Memo video. So that's a regulation. So very, very, very similar structure to, again, the code. Okay, so now let's take a look at a case. So this case going along with, again, our Section 213 issue. This is Ferris versus Commissioner. It's a 7th Circuit case. I can tell because here it's a 7th Circuit. Okay. So in cases are very helpful because they give you some specific facts. And if you look at that How to Write a Memo video, you'll see that this case pertains a lot to our facts. What you're going to see is we have some information, some procedural information here. This is the cite. You always want to know the cite. I'll talk about citations later on, but the cite is very important. We have some procedural information here. Then I got this from Checkpoint. Generally speaking, the head note is what the database, the service provider here, Checkpoint, gives kind of like an editorial. Okay, and generally speaking, that's not the binding or primary authority part of it. The opinion is where the actual official part of the language comes from. So generally speaking, it tells you more procedural stuff. Then it goes into the facts. So the facts are very important when you're dealing with cases because in a memo, like the one we have in the How to Write a Memo video, we have a fact pattern and we're trying to figure out if it applies to what the tax treatment is to our specific taxpayer. So what we do is we look at cases and we compare and contrast facts and the different tax treatment and rationale. So we go through and we look at the facts here, and you're going to see it's somewhat similar to the fact pattern we have. There's different elements that are similar to the fact pattern we have in the How to Write a Memo video, okay, which, again, I recommend looking at that after this video. And I highlighted those facts. And then after it goes through the facts, and it talks about, this is a 7th Circuit, so it talks about the tax courts, the lower level. It talks about the lower level and how they ruled and their rationale. Once you get to where it has this first number 1, now you're finally getting to when the court is starting to talk about the rationale and the application, okay, which you can kind of use in a similar structure for your own memo because that's basically what courts are doing, okay? They're using a similar structure to how your memo should be written. They're referencing law, they're then taking the facts, and then they're applying the law to the facts in a logical fashion to make arguments. Okay, I referenced, they reference the regulation that we looked at, capital expenditures. We just read that, right? So you see how everything's it relates back to one another. Here's where the court is ruling. We believe in the light of the legislative history of Section 213. Look, there's legislative history, by the way. We talked about that. Remember, that was the committee reports, the Joint Committee on Taxation, right? The congressional record, all of those things. That's what they mean by legislative history. So they do reference it, but again, it's only persuasive. It's not binding. The tax court erred as a matter of law and rejected Commissioner's argument. Section 213 by allowing complete deduction, blah, 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 and it goes to the rationale, and I've highlighted all that here, which you could always pause the video. You could pause the video right now if you want to read this and see what exactly they're saying, okay? And they're talking about these issues. But again, I talk about this in the How to Write a Tax Memo video. So that is a case. So again, the case generally takes the format of, we have the facts at the top, then we kind of have the analysis section, then we have conclusion, which if you keep going, you'll see that the court is finally going to talk about what their holding is. For the reasons stated herein, the judgment of the tax court is reversed, so they reverse the tax court's decision, and the cause is remanded for further proceedings back to the tax court, which means that the tax court needs to go back and rule on the facts, because the Circuit Court of Appeals is not a court of fact, it's a court of law. Finally, I have a private letter ruling, which again ties to our situation, which is in the How to Write a Tax Memo video. So private letter rulings, which we saw were non-binding, they also give us, this is from the IRS, they give us a little fact pattern. This head note, again, is checkpoint. So this says tax analyst, which is another database. It's giving us a kind of a summary. So it's not the actual private letter ruling itself. Here is the reference, by the way. The 82 at the beginning refers to, it's in 1982, which you see here. The rest of it refers specifically to what procedurally when it was ruled in the year and what issue of the bulletin, all that stuff. I'm not going to go into that. Here's the text. It goes into the facts and all that stuff. And then it actually talks about how the IRS, how they would rule on the specific case. Now notice, in these private letter rulings, they cite code sections and they cite regulations that we saw before, right? And they also cite cases. And they'll cite other things as well. They'll even cite other private letter rulings. They'll cite revenue rulings. They try to stick with the 1 through 5 items, but the point is that they cite all these things. So you see that it's very circular when you're doing research, that you're going to see elements referencing one another in a circular manner. So that gives you an idea of kind of some of the main types of authority. And by the way, the private letter ruling is, they say how they rule here. Okay. They talk about it. Or on the basis of the information presented, we conclude the amount paid for swimming pool is an expenditure made primarily for medical purposes, medical care, so it can be deducted. Okay. And then it gives like the procedural stuff at every private letter ruling, how other people can't rely on this, and the taxpayer has to include this on the tax return, and blah, blah, blah. Okay. So you see that. So let's go back to our information. I want to talk about evaluating authority, which we've kind of already done, and then finally finish off with the last steps, step 5 and 6, and then give some final tips, additional tips. So here's step 4, evaluating authority. So after we locate authority, it's important to evaluate it. Now I gave that table, and remember there was that column that gave the number, right? And I told you that's just a general rule of thumb to help, students that are entering tax research for the first time. It's not always going to be a matter. And if you have a tax professor, they might view some of these numbers, especially those administrative things with the 8 through 10, they might view them differently. They might say a general counsel memorandum they view as a lower than what I gave a 6, okay? So you got to be careful. But that's generally how I view them, okay? And the 1 through 5 thing, that stays pretty consistent. But again, there might be issues there dealing with that scale. And I mentioned that in this right here. But that scale, it really does help you. Now, there are what are called horizontal and vertical conflicts. Horizontal conflicts mean you have pretty much similar authority. Both are applicable, they apply, but maybe they create different tax treatment or to the situation at hand. So for example, we could have a client that has a reasonable compensation issue, okay? And reasonable compensation, different circuits, as I mentioned earlier in this video, different circuits have different treatment, different tests. Well, let's just say that this specific fact pattern, the client is in a circuit where the circuit has not ruled on what is reasonable compensation or how it's determined, what test to use. So there's different circuits that have their tests, and the idea is that one circuit versus another, well, they're viewed pretty much equal weight in the courts for whatever if they're at the tax court, whatever, they might view different circuits in making their decision. Because they can, and that's what's known as a horizontal conflict, basically, and it might create different outcomes in this situation based on the facts. Vertical conflicts, basically, they involve a situation where you, of course, have one piece of primary authority where it's a 2 versus a 3. So a lot of times what you see is maybe you have a tax court decision and a U.S. Circuit Court of Appeals decision. Well, of course, the U.S. Circuit Court of Appeals decision, that's going to take precedence. But maybe the tax court decision still might be relevant because tax court decisions tend to get more into the nitty-gritty details of facts versus U.S. Court of Appeals decisions, Circuit Court of Appeals decisions, they focus on more broad holdings. So the idea there is, well, can they still be in line? Well, if not, you have to obviously go to the U.S. Circuit Court of Appeals, which could take precedence over the matter. All right. So now let's go to step 5, developing conclusions and recommendations. So step 5 and 6, what we're pretty much doing is we're starting to finalize and write our memo. So step 5, we've gone through, and by the way, remember, we can go back to step 1, 2, 3, 4 anytime at this point and redo things. Look for new facts. Try to get new issues, and get these down. This is kind of like a step to kind of like just think about the whole process. You've identified issues, you found authority, you evaluated authority. Now you kind of have to just think about how exactly are you gonna go through the motions of making the argument for your reader to show them why you think the outcome is the way that you think it is. Okay? Now, step 6 is communicating the recommendations. In almost all tax research classes, focus on the memo. So the memo should follow a fact section, issue section, analysis section, and then finally conclusion section. So the fact section should summarize the important facts of the research case. So if you're given a bunch of facts from a client or you're given a bunch of facts from a teacher, you should pretty much write down the facts in the fact section as clear and concise as possible. Paraphrase them if you want. Make it short because you might have page constraints on the memo, and this is a way to cut down some of the fat off or get rid of the fluff, to get rid of facts that you don't need, that aren't relevant to your determination of the issues, of the outcome. And also you can paraphrase them in a way that makes it more clear and concise. Issue section. So you're going to identify the issue and state the issues in a form of a question. So maybe you have a medical expense question with a swimming pool. That's what we do in the How to Write a Tax Memo video, which I recommend watching after this video. And your question might be, does the swimming pool expenditure qualify as a Section 213 medical expense and deductible in the current year? That might be the issue that you write. Something like that. And I'll show you a memo in a second to give you some ideas. The analysis section, that's where the meat of the memo takes place. So this section discusses the issues. And we've mentioned the issue, and what it does is it takes rules of law, it takes the issues, it shows the progression of the law and how the law is, and evaluating the authority and all that stuff, and it applies it to the facts in a logical manner, and we use, again, that structure of the level of issues, level 1, 2, 3, 4, to go through, and we basically show the reader how we get from the highest level of the code. Okay, Section 213 says that we can take medical expense deductions. What exactly is a medical expense deduction? We define that, the regulations, the code itself. Then we say, okay, well, our taxpayer has a swimming pool. There's a swimming pool here. Well, could that ever qualify as a medical expense deduction? Well, in the Ferris case, it actually could. And in this private letter ruling. Well, are the facts similar in our situation to the Ferris case? Well, yes, they are. They are in this sense, but they're not similar in this sense. They're more similar in this case, but then the private letter ruling comes in and says, and maybe that's where the missing connections are, and that makes sure and ensures them. That's kind of what I did in the How to Write a Tax Memo video. So the analysis section, I have some notes here, and I have some other notes later on that I want to mention, but I have some notes here that you really should focus on. You always